On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Afternoon, everyone. Look, I wanted to jump on here and record a few thoughts about the conflict that we're seeing in Israel and talk about what it might mean for financial markets. And I guess the first point I'll make is that I'm recording this just after midday on Tuesday. And it's such a fast-moving situation that by the time you listen to this, whether you're on the ball and you listen to it as soon as it goes up or in a day or two, things could change. So take this as being my current thoughts based on what we know and what we've seen as of Tuesday lunchtime. But obviously, the conflict over the weekend has added to a list of geopolitical worries that already had a few things on it, whether it's the ongoing war in Ukraine or its tensions between the US and China. It's just another geopolitical issue that we've had to worry about, and it has led to a fresh bout of volatility across financial markets. And the tragic developments we've seen have led to a significant human toll, and the concerns have really been raised about an extended conflict, which no one wants to see. But in terms of the reaction to the initial hostilities, you've obviously got the militants affiliated with Hamas initiating a large-scale attack against Israel. I won't pretend to be right across all of the history because there is a long, decades, if not centuries-long history between some of these groups in this part of the world, and I'm definitely not an expert. But as far as financial markets go, there are a few people that are drawing some parallels with what we saw in the 1970s, and thinking about the potential flow-on effects if you do see other countries get involved, bigger players, and that conflict sort of spilling over into something more significant. Back in the 1970s, you had the Western world mired in stagflation, which is a really undesirable combination of low growth, high unemployment, and high inflation. And there were lots of things that were responsible for that, although the oil shock that we saw in 1973 was probably the most dominant. And whenever there's conflict in the Middle East, you immediately think of what it might mean for the oil markets. And somewhat ominously, last Friday marked 50 years since the Yom Kippur War started. I hope I've got that pronunciation right. You can go back and do some Googling and learn all about sort of that period. But essentially, that was an armed conflict. It lasted for about 3 weeks, and it started with a surprise attack against Israel from a group of Arab states led by Egypt and Syria, but including a few others as well. And I guess that's pretty ominous timing, isn't it? Because now we've seen a surprise attack against Israel at the moment, and we're wondering what that will lead to. But anyway, 50 years ago, 1973, that was a major catalyst for this oil shock, because you did see other countries start to get involved, most notably the United States. And in the eyes of Saudi Arabia, primarily, but also a few others, America's support for Israel was just a little bit too big. And ultimately, you had a lot of tensions emerge, and that led to an oil embargo against the US and some of its other allies. And that oil embargo lasted from October 1973, shortly after this conflict broke out, through to March 1974. So you saw the price of oil skyrocket. It rose almost fourfold. It was about $2.90 a barrel, US dollars, and it sort of quadrupled to almost $12 within a matter of months. And at the time, back then, you already had US inflation that was very high, but it surged to 12% by the end of 1974 as a result of that oil shock. The US economy fell into recession, unemployment peaked as high as 9% in 1975, and it was an awful decade for investors. Obviously you had that conflict and you had the human toll, and we're seeing a little bit of that again, which is obviously deeply troubling. But from a financial markets perspective, the 1970s was somewhat of a lost decade. It was a pretty abysmal period for investment returns. US shares, corporate bonds, real estate all posted annual gains through that period of between 5 and 7%, which were reasonable. However, because inflation was so high, none of those assets kept pace with that rampant inflation, which meant that in real terms, investors went backwards. They earned nothing. They didn't keep up with inflation, so they essentially lost money for the whole 10 years. It was even worse here in New Zealand. Our inflation averaged about 12% per annum. That far outpaced the returns from the local share market, and it completely eroded 10 years worth of house price increases. So that is why people worry about high inflation, stagflation, and not getting those situations under control. And a lot of the time, those periods do start with an oil shock, which is why there's nervousness out there. And whenever you see tension like you're seeing at the moment in the Middle East, back in the 70s, there weren't many places to hide as an investor. Gold did well, commodities did well, and that was pretty much it. You had gold surge about 14-fold over that decade. Since then, it's never even come close to even remotely repeating those sorts of returns. Farmland was also strong. That often goes hand in hand with high commodity prices and the demand for tangible assets that tend to do well when you've got higher inflation. So there were a few things that performed well, and that's, I suppose, why we often say when you're worried about inflation, it does pay to sort of own some commodity linked assets, whether it's oil or energy stocks or commodities or farmland, which tends to do well when commodity prices are high. Gold is another favorite as well, because we look back at periods like the 70s, and that was sort of the playbook that worked back then. Now, despite those somewhat eerie similarities, I don't think we will see a repeat of the 1970s. There are a few things that we have in common with that backdrop today. We've got this period of high US inflation, high inflation everywhere, to be honest. Now we're seeing conflict in parts of the world that could lead to a spike in oil prices. So that's very much a watch this space. But I think today we also do have central banks that are very aware of what happened back then. They don't want to make similar mistakes by taking inflation too lightly. So, like others, the US Federal Reserve has embarked on its most aggressive tightening cycle in decades, and it's now got its policy interest rate, its equivalent of the OCR, that's sitting at about 5.5%, and that's comfortably above the inflation rate. The inflation rate, and we'll get some new figures later this week, is sort of in that 3 to 4.5% zone. So there was a period earlier in the year and last year where the inflation rate in the US was above their policy interest rate. But that was a relatively short-lived period because they've kept raising interest rates and inflation's been coming down. So now you actually have got a positive policy rate in the United States. And in the 1970s, there was a longer period where inflation was quite a bit above that US policy rate. So central banks have a greater awareness that this is something they need to get under control, and they're doing more about it now. And I think that is one key difference. I guess in addition, though, and what's probably less positive for financial markets and investors is that central banks are going to be more inclined to keep interest rates higher for longer when they see things like this out there, and they sort of look at some of those similarities with periods from the past where inflation has surged and become quite problematic. We've also seen the supply chain disruptions of the pandemic era ease, so that's a good thing. We've seen some of that, what we thought for a period might have been sort of quite sticky, quite persistent inflation. Those supply chains have eased and opened up, so that's good. And we've seen commodity prices come down from the highs from last year as well. I know we're seeing a spike now, seen oil prices rebound in the wake of what's happened, but we're still nowhere near where we were last year when that conflict broke out in the Ukraine. So steady as she goes. We do need to keep a very close eye on oil prices. If the tensions ratchet up further, or if you see other countries get involved, they will absolutely rise, and that's something we need to pay close attention to, because it has very significant implications for the inflationary backdrop, for economic growth, and for monetary policy around the world, which all of those things will impact economic growth and investment returns. So it's very much a watch this space. But at least the global economy isn't quite as energy intensive as it was 50 years ago. So, a spike in oil wouldn't have the same impact, but it still would be something we don't want. Now, putting all that together, even if we believe we're not headed for another 1970s sort of oil shock and period of stagflation, which I don't believe we are, still a very uncertain environment, and geopolitical issues like the one that we're seeing at the moment play out are incredibly unpredictable, which is why financial markets find it really hard to put a price on them. It's very difficult to predict what will happen, how it will happen, and what that will mean for different asset classes. So as far as investors go, I think we should expect volatility to prevail, and that's what you're seeing at the moment. However, it's a bit sad to say this, but if the conflict is contained, markets do tend to shake things off and move on relatively quickly. We saw that last year, sadly, with the Ukraine war. A lot of volatility, a lot of uncertainty, a lot of nervousness, but after a period of time, as long as that conflict sort of remained sort of within its initial bounds instead of spreading to other countries or parts of the world, markets did tend to move on and refocus on other more global issues. So I think that is what you'll see here, unless the tensions spread. So we'll be keeping a close eye on that. Immediately, if you're looking to find a way to, protect yourselves in a portfolio sense, the typical flight to safety that you see means that safe haven assets tend to do best, or they tend to be the ones that investors flock to. Things like gold, things like the US dollar, high quality government bonds, high quality fixed income. Those are all the places people will head if they're nervous, and if things get worse, that will even be more so. Within equities, look, I don't think you need to sort of sell your whole equity portfolio, because what you're seeing at the moment, stay calm, focus on defensive companies. If you're able, if your sustainability views allow you to, then owning a few energy stocks can help you weather the storm, because those parts of the market tend to prove most resilient during periods like this. In a regional sense, it's usually the US share market that holds up best. Higher risk regions like emerging markets tend to fare the worst. They're sort of the higher risk ones. They don't benefit from this sort of turmoil or conflict in parts of the world that could be considered emerging. And emerging markets generally do tend to suffer when you have a stronger US dollar. So that would be my advice in terms of the regional sort of winners and losers. But look, we all hope this conflict will subside sooner rather than later, and we certainly don't want it to get any worse. So my advice would be, it's a watch this space. Don't make any rash decisions. Don't sort of run for the hills or panic or do anything dramatic. but we should take a safety first approach. And I think many people are probably taking that safety first approach anyway, because it's been an uncertain environment even before this all emerged. So hopefully you're already well positioned in that regard. If you do have questions, if you are wondering what this means for your portfolio, for financial markets, for the economic outlook, then I would suggest you touch base with your advisor and have a chat and do a little bit of a stock take of your positioning, and just check in to see if there's anything that you should be doing or fine tuning. But for now, we'll leave it there. Hopefully that is useful. Very much a quick take. It's a quickly changing situation. We'll definitely be keeping an eye on it. Myself, the broader investment team, the research team at Craig's will be ensuring that we keep you informed if there are any developments on this front. So keep an eye on the website, stay close to your advisor, and take care, everybody. We'll talk again soon.